This video, I want to talk about emerging market investing in emerging markets. The emerging markets here, are countries that are considered to be developing economically, and they are growing at a rapid rate. Typical examples include China, India, Brazil, South Africa, and countries like Vietnam. And these markets offer opportunities for higher returns due to their rapid growth potentials. And compared to established economy, compared to advanced developed economy, you could stand to benefit maximally from the level of growth that these countries uh, are known to be growing at. They grow rapidly, and they tend to provide kind of higher returns. And so here is a detailed overview of what emerging markets investing is all about. We want to look at the key concepts. So in this case, I would like to consider the definition as well as the purpose, of emerging market investing. So emerging markets is a countries with economies that are in the process of rapid growth, and they are equally uh, developing industrial. They have that rapid rate of industrialization. So these markets are typically characterized by lower per capita income, and they they have this lesser level of uh what you call the financial system is not all that developed, actually, compared to developed countries. Their financial system is just like it's coming up, trying to like find its feet. And the objective here is that they provide that high growth potential, and they equally provide diversification. It's a means of diversifying away from your more stable investment in developed countries. Number two is the characteristics as well as of emerging markets. Emerging markets are characterized by high growth potentials. Emerging markets often experience faster economic growth compared to developed countries. They are driven by factors like industrialization, urbanization, and increased consumer spending. They experience this expansion in the middle class. The middle class is kind of expanding. And not only that, they have volatility. The emerging markets, they are somewhat volatile. These markets can be more volatile due to political instability. They are politically unstable. There's that economic fluctuation. And not only that, they have a less mature financial system. The banking system is kind of less mature. There's that other risk factors, including political instability, currency fluctuation. Like my country recently, devalued its currency, you know, and this can have, a negative impact on people's, investments. It can impact one's investment, you know. So in that case, you have to take this into consideration. The risk factor is equally something we must consider. And there's that political uncertainty, and the regularity of change, is very high. The changes in the country, occurs at a rapid rapid interval. Number three is types of investments. In this case, you talk about stocks, bonds, mutual funds, and commodities, as well as real estate. These kind of investments are very common. They are available in emerging markets. Number four is benefits. We want to look at the benefits of investing in a typical emerging market or emerging economy. There is that growth opportunity. As I told us earlier, it is that potential for higher growth compared to established economy. You could equally incorporate it as a means of diversification. It provides exposure to different economy outside your geographical boundary, outside your home economy. Not only that, it gives you early market access. Just identify a company or a country that is growing very fast and invest in that country early. As the economy does well, as the growth continues, then at the end of the day, you reap a higher returns. You benefit from the growth trends in such economies. Then we also look at the drawback, the disadvantages. That's number five. This higher risk. So you are exposed to political risks, economic risk, company-specific risk, which can impact your investments negatively. It's somewhat risk. Although the returns are encouraging, but don't forget the risk. The political risk is there. The economic fluctuation is there to grapple with. You have market volatility, so there's greater fluctuation, in market performance compared to stable or developed economy or developed markets. There's less transparency. It's not as even the accounting, the reporting process is not as transparent as what is obtainable in matured economies. So you have to really make sure that you take the figures there with a pinch of salt, because of the lesser level of transparency. That is it. The next one is strategies for emerging market investing. What are the strategies you could adopt when it comes to emerging market investing? You consider diversification. So you spread your investment across various countries, not just in a single country. You incorporate other emerging countries as well. That will go a long way in mitigating your risk, in lowering your risk. In case a particular country is not doing well, then other countries in the portfolio could give you the kind of returns you desire. Number two is research and analysis. So you conduct thorough research, on the economic condition of the country you want to invest in. You also consider political instability. You don't go and invest in Haiti. That is, I think, is almost like governed by gangs. So you consider political stability as well as the market trend in those countries. Number three is use of funds. So you consider investing in emerging markets, mutual funds, or ETFs. Instead of picking individual stocks, you may invest in country-specific mutual funds or emerging market-specific mutual funds or ETFs, to gain a broad, diversified exposure, as well as you leverage or take advantage of professional management that these funds, offer. So number four, you monitor economic indicators. You become an economist by force. You become a macroeconomist by necessity. So you keep track of the economic fluctuation. You keep track of this country GDP, the inflation rates, the unemployment rate, the interest rates, and the impacts these rates have on the emerging market economies. So you will learn to be an economist if you want to benefit from emerging markets investment and strategy. So who is this particular strategy meant for? It's meant for growth-oriented investors. You want to grow. You want growth in your portfolio. You want a higher level of return. So I would advise you incorporate or include emerging markets, securities or investment in your portfolio. It's for long-term investors. You are there for the long term. If you invest early in an emerging market, in the next 5, 10 years, I'm telling you, you have something substantial. What is could even outperform the a typical mature economy, stable economy. Then of course it serves as a means of diversifying your portfolio. You want to diversify, you could diversify across different emerging countries, emerging markets. You could invest in China, Brazil, South Africa, Vietnam, like that at a go. You see, so it provides diversification. You want to diversify your portfolio, this particular strategy is a good fit for you.